Hey there, welcome to Everyday English Pod. Today we're doing something a little different. We've taken a look at some recent business English learning materials, specifically focusing on how financial topics, come up in professional conversations. Our mission here is really to pull out the useful stuff, the insights into how people talk about money in a business context, what the key concepts are, and ultimately to give you some aha moments without drowning you in jargon.
That's right. We're essentially giving you a kind of shortcut to understanding these important financial discussions. The source material we looked at covered a really wide range of scenarios. Everything from the regular check-ins on how the business is doing.
Right, the day-to-day stuff.
To bigger strategic decisions like expanding overseas. So whether you're prepping for a meeting, trying to get a handle on business finances, or maybe just naturally curious, we're going to break it all down for you in a way that's hopefully easy to follow.
Okay, let's jump right in then with something pretty standard in the business world, the quarterly financial review. It's kind of like taking the pulse of the company, right?
Exactly. So a typical quarterly review often kicks off with looking at the income statement. The materials we reviewed talked about solid 12% growth in revenue compared to the quarter before.
Yeah.
That's generally a positive signal.
Definitely. And what was interesting was that even though their operating expenses, things like marketing and salaries for new hires went up by 7%.
Which you'd expect, yeah.
Which you'd expect to see with growth initiatives, yeah. Their profit margins actually improved slightly, reaching 19.5%. So for you, the listener, the key here isn't just that the profit margin went up, but that it shows the company's becoming more efficient at turning sales into profit, even while investing.
Exactly. It means the revenue is increasing at a faster rate than their expenses, basically.
Yeah.
Then they moved on to the balance sheet. And a big point there was their improved liquidity. The current ratio went from 1.8 to 2.1.
Oh.
Think of the current ratio as like a quick health check. It shows if a company has enough readily available assets to cover its short-term bills.
Yeah.
A higher number generally suggests they're in a better spot to handle those obligations.
Right. More breathing room financially. And they also noted that they weren't relying as much on borrowed money, Their debt to equity ratio dropped from 0.7 down to 0.6. Now, for you, the interesting part is what this meant. Because they had less debt relative to their ownership stake, their interest expenses actually went down by 8%. That's real money back in their pocket.
Absolutely. Lower interest payments free up cash for other things like, research or investments. The discussion then turned to the cash flow statement, which showed a strong 15% increase in operating cash flow.
Wow.
Yeah, this was apparently because they were doing a better job of collecting payments from customers, getting paid faster, and managing their inventory more efficiently, so less cash was tied up in warehouses.
Which, as they say, cash is king. But wasn't all just cash coming in. They made some pretty significant investments. $2 million in new equipment and $1.5 million in software upgrades.
Right.
So it's not just about how much cash a business generates, but also how it's being used to grow and improve.
Exactly. And even with those substantial investments, their free cash flow, that's the cash left over after covering operating expenses and those capital expenditures, it still increased by 5%.
That's pretty good.
That tells you the core business is really healthy and generating more than enough cash to cover its needs and still have some left over. They also mentioned they paid out a consistent dividend of 50 cents per share to their investors.
So if we step back for a moment and look at this quarterly review as a whole, what really jumps out? What should you, the listener, be paying attention to in a situation like this?
Well, the clear positives are the improved ability to meet short-term obligations, the liquidity we talked about, the consistent growth in sales, and the strong cash generation. These are all hallmarks of a financially sound company.
I agree. However, one area they highlighted as something to watch was those operating expenses. While they're currently manageable, keeping an eye on them to ensure they're truly driving growth and not just, creeping up inefficiently is always important.
Good point.
And one last thing to note is that their current financial performance is actually a little bit ahead of what they had predicted for the year. Revenue is up by 3% and net income by 2%, I think.
Which suggests they're on track for a good year, assuming these positive trends continue. Okay, let's switch gears and talk about how a company manages its money for the longer term, their investment strategy.
Right. This part of the materials outlined how the company is currently allocating its investments. They had a mix of assets, 60% in stocks, 30% in bonds, and 10% in cash equivalents. This kind of mix is pretty common, right? Trying to balance potential returns with managing risk.
Exactly. And it seems this approach has been reasonably successful, as they achieved a 7.5% return on their investments over the past year, which was slightly better than their benchmark. That's like the average return of similar investments, which was 7%.
Nice. They also pointed out that they were overweight in the technology and healthcare sectors. What that means for you is they had a larger percentage of their stock investments in these areas compared to the overall market. And these sectors apparently played a big role in their outperformance. It really shows how choosing the right sectors can impact your returns, doesn't it?
It really does.
Yeah.
And what's fascinating here is they also had 15% of their investments in what are called emerging markets, countries with economies that are still, developing. They noted that this area had mixed results recently due to some economic ups and downs in those regions. This really highlights for you the higher potential returns, but also the greater volatility that comes with investing in these markets.
Yeah, higher risk, higher reward, potentially. Now, given the current economic uncertainty we're all seeing, there was a discussion about possibly adjusting their investment strategy. They talked about potentially increasing their holdings in more stable defensive sectors.
Like utilities or consumer staples.
Exactly. Think of companies that provide essential goods and services that people need no matter what the economy is doing. And they considered reducing their exposure to cyclical industries, businesses whose performance tends to go up and down with the overall economy, like luxury goods or travel. That makes sense, right? In uncertain times, you might want to lean towards more predictable areas.
It does. For the bond portion of their investments, they're focusing on corporate bonds that mature in the short to medium term. This is a way to generate some income while also trying to limit the risk associated with longer-term bonds if interest rates were to rise.
Right, managing that interest rate risk. And with their international investments, they're using a combination of what's called currency hedging, basically taking steps to protect themselves against unfavorable changes in exchange rates and diversifying their investments across different countries. It's all about trying to manage risk from different angles.
They also had a small portion of their investments in alternative assets, like REITs, real estate investment trusts, which allow you to invest in real estate indirectly, and commodities, like oil or gold. These can act as another way to diversify their portfolio. And then the conversation touched on something increasingly important for many investors: ESG investing.
Oh yeah, that's environmental, social, and governance factors. They were thinking about putting more of their money into companies that perform well on these measures, noting that this can potentially lead to lower risk in the long run. It's becoming less just about the pure financial numbers.
Which is a trend we're seeing more and more. It's about considering the broader impact of investments. They also confirmed that they have enough cash on hand to cover about 6 months of their operating expenses, which is a good safety net.
Definitely important for peace of mind. Looking ahead, they identified some key economic factors they'd be keeping a close watch on: inflation, changes in interest rates, and geopolitical tensions. All of these things can have a significant impact on how investments perform.
Absolutely. And finally, they discussed how often they should review and adjust their investment portfolio. They recommended doing this quarterly, or whenever a particular type of asset becomes more than 5% different from their target allocation. It's about staying proactive and making adjustments as needed.
So what does this all mean for you? It gives you a look at the careful planning and ongoing management that goes into a company's investments. They're not just like throwing money at things. They're considering different types of assets, the economic climate, and even broader ethical considerations.
Exactly. It's a continuous process of monitoring and adapting. Now, let's move on to something that happens every year in business: annual budget planning.
Right. The material we looked at started with a really crucial step, looking back at the previous year's budget and comparing it to what actually happened. This helps you see where you were on track and where things, went differently.
And they mentioned a couple of notable differences or variances.
Yeah.
They spent 15% more on marketing than they had budgeted for, which was apparently because a really good opportunity for a big campaign came up unexpectedly. And they spent 10% less on research and development, R&D, because some projects got delayed. Understanding the reasons behind these variances is so important for better planning going forward.
Absolutely, because what you learn from the past directly influences how you plan for the future, right? They talked about needing to build more flexibility into the marketing budget, recognizing that those unexpected opportunities can arise.
Makes sense.
And for R&D, they discussed setting clearer milestones for projects to try and avoid those delays that lead to underspending.
When it comes to actually predicting how much money they'll bring in for the coming year, the revenue projection they recommended using a bottom-up approach. What that means for you is they start by getting sales forecasts from each individual department or division, and then they add those all together to get an overall revenue projection for the company.
That makes sense, getting input from the folks who are closest to the customers in the market. And because the economic future isn't always crystal clear, they stress the importance of creating different possible scenarios. A most likely or base case, a more optimistic case, and a more cautious pessimistic case. This helps them prepare for a range of potential outcomes.
Good thinking. They also touched on ways to save money, like finding efficiencies in their supply chain, how they get their materials and products, and renegotiating long-term contracts with their suppliers. Every bit helps.
Now, when different departments inevitably ask for more money in their budgets, the recommendation was to make sure they provide detailed reasons for those requests and clearly show how those increased budgets will help the company achieve its key goals, what they call key performance indicators, or KPIs.
Yeah, tying it back to strategy.
It's about making sure every extra dollar is tied to a specific objective.
They suggested a 2-month timeline for the whole budget approval process, which seems like a reasonable amount of time for careful consideration. And once the budget is approved, they recommended reviewing it every month. This allows them to stay on track and make adjustments if the business environment changes,
Right, it's not just set in stone. And in terms of tools, they recommended upgrading to budgeting software that works in the cloud and can connect with their other financial systems. This can really make the whole process smoother and more accurate.
Definitely helps with real-time data. Finally, they emphasize how important it is to get everyone on board with the budget, especially the heads of each department. This means involving them early in the planning process and clearly explaining how their individual budgets contribute to the overall success of the company. That feeling of ownership is key to making the budget work.
So the big picture on annual budget planning is that it's a really comprehensive exercise. It involves looking at past performance, predicting the future, considering different possibilities, and making sure everyone in the company is aligned on the financial plan for the year ahead. It's not just about the numbers, it's about strategy and communication too.
Exactly. It really sets the financial direction for the entire year. Let's move on to another crucial area for any business: how they manage risks.
Okay. The materials we reviewed identified the main risks the company is currently facing as cybersecurity threats, potential disruptions in their supply chain, meaning problems getting the materials they need, and the ongoing need to comply with all the relevant regulations. These are definitely common concerns for businesses today, huh?
Very much so. They outline what they're currently doing to deal with these risks, including having strong cybersecurity systems in place, using a variety of different suppliers so they're not too dependent on just one.
Diversification, yeah.
And having a dedicated team that focuses on making sure they're meeting all the legal and regulatory requirements.
But the world changes and new risks emerge. The discussion also highlighted some of these newer risks, specifically those related to climate change, and the need for the company to do a climate risk assessment to understand potential future challenges. This shows a forward-thinking approach.
Absolutely. They also talked about their insurance coverage. While they had looked at their policies recently, they realized they might need to increase their cyber insurance because of the growing number of cyber attacks happening to businesses.
Yeah.
That's a constant battle.
Yeah, you can never be too careful there. When it comes to how often they think about risks, they currently do a full risk assessment once a year, with more frequent check-ins, say, every 3 months on their biggest risks. However, given how quickly things can change, they were considering moving to a system of more continuous risk monitoring,
which would allow them to react more quickly to new threats or changes in existing ones. To make sure everyone in the company is aware of the potential risks, they stress the importance of better risk training programs and making sure that thinking about risk is part of how people make decisions at all levels. It's not just the job of, the risk management department.
Right, embedding it in the culture. On the financial side of managing risk, they talked about using tools like forward contracts and options to protect themselves against changes in currency exchange rates and the prices of raw materials they use.
Hedging tools.
Exactly. And apparently these strategies have been pretty effective, reducing their potential losses by about 60% over the past year.
That's a significant amount of protection. Interestingly, they also mentioned that they are choosing to accept some risks related to market competition, where trying to prevent those risks would actually cost more than the potential losses they might incur. It's a calculated decision based on a cost-benefit analysis.
Right, you can't mitigate everything. And to understand the potential impact of those risks they've decided to accept, they're using techniques like scenario analysis, looking at different possible future situations, and Monte Carlo simulations, using computer models to estimate a range of potential outcomes. It's all about trying to put numbers on the potential downsides.
So the overall picture of risk management is that it's an ongoing process of identifying what could go wrong, figuring out how likely it is and how bad it could be, taking steps to reduce those risks, and then constantly monitoring the situation. It involves both taking proactive steps and being willing to accept certain risks if the cost of avoiding them is just too high.
Exactly. And it needs to be something that everyone in the organization is thinking about. Now, let's talk about a big strategic move a company might consider: a potential acquisition of another company, buying someone out.
Yeah. The scenario presented was a company looking at buying another business that had strong potential for future growth and could create significant synergies, meaning ways the two companies could work together to be more successful than they would be on their own. This is often a main reason why companies decide to acquire others.
They noted that the target company was in good financial shape. It had a strong balance sheet with not much debt. Its sales had been growing steadily by 15% each year.
Impressive growth.
And its EBITDA margins, that's earnings, before interest, taxes, depreciation, and amortization, a key measure of operating profitability, were around a healthy 22%. Those are attractive numbers.
Definitely. However, the price they would have to pay was a bit higher than average for that industry, at 12 times their EBITDA compared to the average of 10. So the potential benefits of the acquisition would really need to justify that higher price tag, wouldn't they?
For sure. In terms of those potential benefits, they anticipated saving money in areas like their operations and supply chain by combining the two businesses, as well as increasing sales by being able to cross-sell, offer their products and services to each other's customers.
But buying another company isn't easy. They highlighted potential challenges, like difficulties in bringing the two companies together smoothly, the integration process, potential clashes in their company cultures, which is a big one.
Always tricky.
And the need to upgrade and integrate their IT systems, which can be a huge and costly project.
Financially, they estimated that the acquisition would increase their leverage ratio, that measure of debt compared to equity, from 0.3 up to 0.5, which they felt was still a manageable level of debt.
They discussed different ways they could finance the deal, including using cash they already had, borrowing more money by issuing new debt, and possibly even selling a small amount of new shares in the company. It's about finding the right mix of funding.
The estimated timeline for fully integrating the two companies was quite long, 12 to 18 months, which shows it's a significant undertaking. It's not overnight.
No, definitely not.
Yeah.
They also mentioned the need to get approval from regulatory bodies, specifically mentioning an antitrust analysis to make sure the acquisition wouldn't significantly reduce competition in the market. Got to cross those T's.
And crucially, they confirmed that buying this company would fit well with their overall long-term strategic goals of expanding their share of the market and offering a wider range of products. It needs to make sense in the bigger picture, not just be a deal for deal's sake.
Absolutely. The proposed timeline for the initial due diligence, that's like a really deep investigation into the target company's finances and operations, was 60 days, followed by 30 days for negotiating the final terms of the deal.
And they identified a team of people from different parts of their company, including finance, legal, operations, IT, as well as external advisors who would be involved in that due diligence process. You need all hands on deck for that.
Absolutely. So the main point about potential acquisitions is that they are complex deals. They require a lot of careful evaluation of the target company's financial health, its value, the potential benefits, the risks involved, how the deal will be financed, and how it all fits into the acquiring company's long-term strategy. Thorough investigation due diligence is absolutely key.
Couldn't agree more. Now, let's shift our focus a bit to how a company can stay competitive by upgrading its technology specifically, modernizing its financial systems, getting up to date.
Right. The discussion identified three main areas where they felt upgrades were needed. Their ERP system, which is the core software they use to manage most of their business processes.
The backbone, really.
Yeah, exactly. Then a new system for managing their cash and financial risks called a treasury management system. And finally, improvements to their ability to analyze their data analytics capabilities.
These sound like significant tech investments. What were the expected benefits they mentioned?
Well, things like improved efficiency in their financial processes, better real-time visibility into their financial data, seeing what's happening now, enhanced management of their cash flow, and more reliable financial forecasting. All of these can give a company a real advantage.
Sure can. But what about the cost? That's always a factor.
Yeah, the estimated cost was pretty substantial, $5 million for the initial investment, plus ongoing annual costs of around $1 million for things like maintenance and software subscriptions. So it's a significant commitment of resources.
And what kind of return were they expecting on that investment, the ROI?
They projected a 25% return over 5 years, mainly through the cost savings they would achieve from the new efficiencies and the better decision-making that comes with having better data.
Makes sense. How would they roll it out? All at once?
The implementation of these new systems would happen in stages over 18 months, starting with the ERP system, then the treasury system, and finally the data analytics capabilities. This phased approach helps to manage the disruption and allows them to, learn and adjust as they go.
Of course, with any big IT project, there are potential problems, right? What risks did they identify?
They identified risks like disruptions to their daily operations during the changeover, challenges in moving their existing data over to the new systems. Data migration is always tricky, and the need for their employees to learn how to use the new tools effectively. User adoption is key.
So how would they mitigate those?
Their proposed ways to deal with these risks included investing in comprehensive training programs for their staff, doing thorough testing of the new systems before they fully go live, and having a strong change management plan in place to help people adapt to the changes. Communication is vital there.
They also considered how these new systems would work with their existing IT infrastructure, noting that they would need to make sure they were compatible through things called APIs and potentially build some custom connections for older systems. Integration is never simple.
No, it isn't. And data security is obviously a huge concern. They outline measures like encrypting their data, using multi-factor authentication to prevent unauthorized access, and conducting regular security audits.
Importantly, they also talked about how these new systems would help them meet regulatory requirements by providing better records of their financial activities, better audit trails, automating some compliance checks, and giving them more comprehensive reporting abilities.
They recommended putting together a cross-functional team, people from different departments, led by their chief technology officer, but with strong involvement from the finance team, to really drive this technology upgrade project.
And when it comes to choosing the right companies to provide these systems, the vendors,
they emphasize the importance of a thorough process, including sending out a request for proposals, RFP, watching demonstrations of the software, checking references from other companies that use their systems, and even visiting some of those companies' site visits to see the systems in action. You really have to kick the tires.
So the key message about modernizing financial systems is that it's a big investment that can lead to significant improvements in efficiency, provide valuable insights, and help manage risks better. However, careful planning, strategies to minimize potential problems, and getting everyone on board are all critical for it to be successful.
Absolutely. It's a major undertaking. Now let's think about a company that's looking to expand its reach by moving into the Asian market. Big step.
Yeah, big step indeed. They discussed different ways they could finance this significant expansion, including using profits they've kept within the company, that's retained earnings, issuing corporate bonds, or getting a loan from a group of banks, which is called a syndicated loan.
As they pointed out, each of these options has its pluses and minuses, right? Using retained earnings is the cheapest, probably, but it might limit the money they have for other investments. Bonds can offer a fixed interest rate, which is nice for predictability, but you need a good credit rating to issue them at a favorable rate. Syndicated loans can provide a lot of money, but the interest rate might change over time.
So what did they lean towards?
Given their current financial situation, they suggested using a combination of their retained earnings and a syndicated loan to balance keeping costs down with having enough flexibility. They estimated they would need around $50 million over the next 2 years for this expansion. That's a lot of capital.
Definitely. And if they were to borrow, say, half of that amount through a syndicated loan, what would that do to their debt levels?
They projected that their debt-to-equity ratio would go up from 0.4 to about 0.55, which they still considered to be a reasonable level of debt for their company and industry.
Okay. Now, expanding into a new international market introduces the risk of changes in currency exchange rates, right? How did they plan to manage that?
Good question. They discussed ways to manage this, such as trying to naturally balance their income and expenses in the local currencies as much as possible. This is called natural hedging, and using forward contracts to lock in exchange rates for any remaining exposure they couldn't naturally hedge.
What about the cost of that loan, the syndicated loan?
They estimated that the interest rate based on current market conditions and their creditworthiness, would likely be around LIBOR plus 150 to 200 basis points.
Okay.
They also suggested a loan term of 5 years with an option to refinance after 3 years, which would give them some flexibility as their Asian operations grow and hopefully become more profitable.
And lenders usually have conditions, right? Covenants.
Yes, exactly. Lenders who provide a syndicated loan will usually require the company to agree to certain conditions, called covenants. These are essentially promises to maintain specific financial ratios, like having enough earnings to cover their interest payments and not taking on too much additional debt without permission.
Now, taxes are always a consideration internationally. How did they approach that?
To try to be as tax efficient as possible in their Asian operations, they considered setting up a regional holding company in a country with favorable tax laws, like Singapore, to manage their different businesses in the region. Strategic structuring.
And when it comes to bringing any profits they make in Asia back to the parent company, what's called repatriation of profits, what was the plan there?
They emphasized the need for careful planning to balance reinvesting those profits back into their Asian business to fuel growth versus the tax implications of sending the money back home. They might use things like intercompany loans or dividends, but it needs careful thought.
How long would it take to get all this financing in place?
They estimated that it would probably take around 2 to 3 months to arrange the financing for a syndicated loan of this size, including all the negotiations and paperwork.
So when a company decides to expand internationally, there's a lot of financial planning involved, isn't there? From figuring out the best way to raise the necessary capital to managing the risks of dealing with different currencies and optimizing their tax structure.
Absolutely. It's a complex financial puzzle. Now let's think about how a company can become more efficient and save money by improving its cost structure, getting leaner.
Okay. The materials we looked at identified 3 main areas where a company can often find opportunities to reduce costs: by making their operations more efficient, by optimizing how they purchase goods and services, that's procurement, and by looking at functions that aren't central to their core business that could potentially be outsourced.
Right. For making their operations more efficient, they suggested things like implementing lean management principles to eliminate waste, automating repetitive tasks with technology where possible, and streamlining their supply chain, how they get their products from raw materials to customers.
And they put a number on that.
Yeah, they estimated that these kinds of changes could potentially lead to a 10 to 15% reduction in their operating costs over about 18 months. That's a significant saving if they can achieve it.
Definitely. What about procurement? Buying stuff better.
In terms of procurement, they recommended consolidating their list of suppliers to try and negotiate better discounts for buying in larger quantities, and also implementing a more strategic approach to sourcing all of their key materials and services, not just buying reactively.
And the outsourcing piece, what functions were they looking at?
They considered outsourcing some functions that are not part of their core business, like IT support, processing payroll, and some administrative tasks, as a way to potentially reduce costs. However, they also acknowledged that this could have an impact on their employees.
Yeah, the workforce impact.
Possibly leading to a 5 to 7% reduction in their workforce, mainly in those support roles.
Recognizing that potential job losses are a sensitive issue, how did they suggest handling that?
They stressed the importance of being transparent in their communication with employees, offering retraining opportunities where possible for those whose roles might be changing, and providing outplacement services to help those who are laid off find new jobs. Handling it respectfully is key.
Another area where they looked for potential savings was in their real estate footprint. What did they consider there?
They considered things like consolidating their office spaces and implementing hot desking arrangements where employees don't have assigned desks, which they estimated could reduce their real estate costs by as much as 20%. That's a big chunk of overhead.
How quickly would they implement these changes?
They proposed taking a phased approach to implementing these cost-saving measures over a period of 24 months, starting with some of the quicker wins in procurement and gradually moving towards more significant structural changes in their operations and workforce.
It's really important, though, to make sure that these cost reductions don't end up hurting the quality of their products or the satisfaction of their customers, right?
Absolutely crucial. They emphasize the need to set up clear ways to measure these things, those KPIs again, and to be ready to adjust their cost-saving strategies if they see any negative impacts. You don't want to save money at the expense of your core business.
They also mentioned looking at their energy costs.
Yeah, and exploring initiatives like investing in more energy-efficient equipment and possibly even using renewable energy sources for their facilities to reduce their long-term energy expenses. Sustainability and cost savings can go hand in hand sometimes.
Finally, they discussed the idea of giving managers incentives to actively look for and implement cost-saving measures.
Yes, perhaps by tying a portion of their bonuses to achieving specific cost reduction targets, while also making sure they maintain overall performance levels. It aligns incentives.
So the effort to improve a company's cost structure is a broad one. It involves looking at many different parts of the business, from how they operate to their overhead expenses. The key is to find efficiencies without negatively affecting the quality of their products or the morale of their employees. It's a balancing act.
A tricky balancing act, for sure. Now let's talk about what a company does with the money it makes specifically, reviewing its dividend policy, which is how it decides to share profits with its shareholders.
Right. The scenario outlined a company that currently pays out 40% of its net income as dividends, and they've been doing this consistently for the past 3 years. How does that compare to others?
They noted that this is slightly lower than the average for companies in their industry, which is 45%, but their dividend yield, the annual dividend payment as a percentage of the stock price, is still competitive at 3.2%.
Okay, so given that the company has been performing well financially, what were they considering?
They considered a modest increase in the dividend payout ratio to 45%. This would bring them more in line with their peers and could be seen by investors as a sign of confidence in the company's future earnings, a positive signal.
What would the impact of that increase be on their cash?
They analyzed that, estimating it would reduce the amount of cash they have in reserve by about $10 million each year. However, they believe they would still have enough cash on hand, sufficient liquidity to fund their planned investments and operations.
Did they consider tax implications?
They did. They also considered whether there might be any changes in tax laws that would affect dividends, but it seemed that no significant changes were expected. However, as they rightly pointed out, it's always a good idea to consult with tax advisors, just to be sure.
What about alternatives to dividends, like share buybacks?
Yeah, as an alternative to increasing the dividend, they discussed the possibility of buying back some of their own shares on the market. Share buybacks can be a way to return value to shareholders and can sometimes be more tax efficient than dividends. However, they acknowledge that some investors, particularly income-focused ones, prefer the regular income from dividends.
Would increasing the dividend hurt their credit rating?
They looked at that too. They concluded that a modest increase, given their strong financial position, shouldn't have a negative impact. However, they wisely suggested running some financial models just to be certain before making a final decision.
What's the message an increased dividend sends to the market?
Well, they highlighted the potential positive message. It can signal that the company is confident in its future cash flows and is committed to returning value to its shareholders, which can potentially attract more long-term investors.
How often should they review this policy?
They recommended reviewing their dividend policy on an annual basis moving forward to make sure it still aligns with their financial goals and market conditions and allowing them to make adjustments if needed. It's not a set it and forget it thing.
Did they mention other dividend strategies?
They also briefly mentioned the idea of a progressive dividend policy, where the company aims to increase its dividend payments gradually over time. While this can be very attractive to investors, it requires a high degree of confidence in the company's ability to sustain those increasing payouts. You don't want to have to cut it later.
Right. And special dividends.
Another option they considered was special dividends, which are one-time extra dividend payments that a company might issue if they have a large amount of excess cash, particularly after a period of exceptionally strong financial performance. This allows them to return cash to shareholders without making a permanent commitment to a higher regular dividend.
So ultimately, what's the goal here?
Ultimately, they emphasize the importance of finding the right balance between rewarding their shareholders with dividends and retaining enough earnings within the company to fund future growth opportunities and maintain a healthy financial cushion. They suggested keeping a dividend coverage ratio, the amount of net income divided by the total dividends paid, of at least 2 to ensure they have enough earnings to support both.
So reviewing a dividend policy is all about finding that sweet spot between rewarding investors, signaling financial health, and ensuring the company has enough resources for future growth. It's a key way they communicate with the financial world.
Exactly. It sends important signals. Now, for our final topic, let's discuss what a company does to prepare for its annual audit by external accountants, getting ready for the auditors.
Okay. The discussion covered the beginning of an internal pre-audit review. Where do they start?
They start by looking closely at areas that have been identified as potential risks or areas of concern in previous audits. These included how they recognize revenue, how they value their inventory, and their policies for international transfer pricing, which is how they account for transactions between different parts of their company located in different countries. Always complex areas.
Did any new accounting rules come up?
Yes. They noted that they had implemented a new accounting standard for leases during the year, which would have a significant impact on their balance sheet. They emphasized the need for a thorough internal audit review of how they had adopted this new standard before the external auditors arrived. Got to be ready for questions on that.
What about internal controls, the checks and balances?
They also mentioned improvements they had made to their internal controls, the processes and procedures they have in place to ensure the accuracy of their financial information and prevent fraud. Specifically, they had enhanced their IT general controls and were documenting these improvements using a control matrix and a new software system called Governance, Risk, and Compliance, or GRC software, to keep track of changes and testing. Documentation is key for audits.
Anything changing in the future they needed to consider?
Looking ahead, they noted that there were upcoming changes to the accounting rules for financial instruments that they would need to start preparing for the next year to ensure they remain compliant, always looking ahead.
How do they ensure the accuracy of the disclosures, the notes in the financial statements?
To make sure their financial statement disclosures are accurate, they had implemented a disclosure checklist and were having a peer review process where someone else checks their work for all significant disclosures. This adds an important layer of quality control.
Did their recent expansion affect anything?
With their recent business expansion, they were also reevaluating their reportable segments, meaning they might need to start reporting the financial performance of a new geographic area separately if it has become significant enough under the accounting rules.
What about valuing things that aren't physical assets?
For intangible assets, things like patents or trademarks that they had acquired in a recent acquisition, they had hired a third-party specialist to determine their value. This is particularly important for assets that don't have a physical form and whose value can be more subjective. Getting an expert opinion helps.
Were there areas requiring significant judgment?
Yes, they identified areas where they might need to make significant judgments or estimates in their financial reporting, such as testing for the impairment of goodwill, which is essentially assessing whether the value of an acquired company has decreased since they bought it, and the valuation of their employee pension obligations. These areas often require careful consideration and can involve assumptions about the future.
How do they support those judgments?
To ensure that these judgments and estimates are reasonable, they suggested having their underlying assumptions reviewed by external experts. This provides an independent perspective and adds credibility to their financial reporting, especially for the auditors.
And who oversees all this preparation?
Finally, they discuss scheduling a meeting with the audit committee that's a group of members of their board of directors who are responsible for overseeing the audit process to review their progress in getting ready for the annual audit. They plan to prepare a comprehensive pre-audit report for this meeting.
So preparing for the annual audit is a really detailed and thorough process, isn't it? It involves looking at potential risk areas, making sure they're following all the accounting rules, documenting their internal controls, and carefully considering any areas that require significant judgment. It's all about ensuring that their financial statements are accurate and reliable.
Precisely. It takes a lot of work behind the scenes.
Well, there you have it, a pretty detailed look into a range of important financial discussions that happen in a business setting. Hopefully you, our listener, found this to be really insightful and not too overwhelming.
Our goal was really to extract the practical knowledge and give you a good sense of how these financial topics are actually discussed in a professional environment,
Whether you're preparing for a finance-related meeting yourself, trying to better understand the world of business, or maybe just satisfying your curiosity, we really hope this has given you a stronger grasp of key financial principles in action.
And it really shows how all these different areas of finance within a company are interconnected, doesn't it? None of it happens in a vacuum.
Absolutely. Now, for one final thought for you to consider, looking at all these different financial discussions we've had today, from quarterly results to acquisitions to dividends, what single aspect do you think is the absolute most critical for a company to be successful, and why do you think that is? It's just something to think about as you go about your day. Thanks so much for joining us here on Everyday English Pod.